This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. Alright, can we make a start on capitalised pricing model, please? Can we? Here, it is relatively easy. A lot of this you've seen before, in fact. A lot of this you've seen before. But it's back to something I said earlier. Hello? I have a struggle here. We don't know the new examiner well enough. The old one, Scott, whatever his name was, did have this habit of keep throwing in bits that needed formulae, which weren't on the formula sheet. There aren't many. And they're very easy to use. The new examiner might not do that. It is a bit unfair, but we've got to assume he might. All right? So as we go through this, there aren't that many formulae. But I'll make it clear, and I suggest you make a mark or something, which ones you're given and which ones you're not. That might be asked that you better learn. Okay? But I say, almost all of them are actually very easy. The trouble is, each of these funny ones has only ever been asked once or twice. You know, it might never be asked again, but it's better to be safe than not. The first one is very much a definition formula. You know, I'm not going to prove any of the formulae, those will be here forever. This one can't be proved, really, it's definition. But I said the risk in any share, I wrote up, there are two elements to it, without repeating the description, the systematic and the unsystematic. All right? Well, the first formulae, which is on page 37, the total risk is the two together, but in fact, it's not a straight add-up. It doesn't really matter. We in fact have the variances. We say the total risk squared. It is systematic and unsystematic, but we have the squares of them. You understand what I'm getting at here? So it's the systematic risk squared plus the unsystematic squared. Well, that's not given. I say it's a definition formula. But it does mean, it's all a bit silly, quite frankly, but it was in a question once. It does mean that if we know any two, you know, we can work out the third. All right? So, on each of these, just let's do one to check you can use it. But look at example 1. Shares in X have a total risk of 18. Total risk. The standard deviation, you know. I showed you how we calculated it, but you're given it. But the total risk is this combination of the two. Somehow we've identified the unsystematic risk is 5%. Can you all write down, please, what must the systematic risk be? Well, total risk 18 squared is systematic risk squared plus unsystematic 5 squared. provided you've put the right figures in your Katerina, it's then just a relatively easy playing with the numbers. The systematic risk is 17.29. Okay? On its own, all a bit silly, but I say I have to go through each one. And as you see, I'll give you a little challenge later, putting a few together. But regardless. Okay? So, there, an easy one. Are we all right there, you Katerina? Fine. I said earlier that provided we were well diversified, which from now on we will assume, if we're well diversified, it's only the systematic risk we're concerned about. So it's the level of this systematic risk that'll decide what return we need. In real life, the way we measure systematic risk, instead of actually quoting it as a figure and saying it's 17%, standardly we measure it relative to the stock exchange as a whole. The stock exchange as a whole is risky. The stock exchange, I don't know what they call it here, Rigibor or something, the average, it goes up and down, there is risk. But clearly individual shares, individually some shares are more risky, some less risky. The index is the average. Well, instead of quoting and saying, this one's got 17%, that one's 2%, and so on, we quote the risk relative to the stock exchange. And so your next formula, we call it beta. The standard measure of risk is the beta. And it is simply the systematic risk, which is what we're measuring, relative to, divided by, the risk of the market. And what we mean by the risk of the market is the stock exchange as a whole. Or the stock exchange average. All right? Well, again, that formula is not given. But when you've used it once or twice, that's a formula that becomes almost automatic. Just look at example 2. Example 2. Y PLC has systematic risk of 8%. The stock exchange as a whole, the market risk is 10%. Well, again, standardly we express the risk as a proportion of the market. So the beta of Y, systematic 8, the market's 10, the beta is 0.8. As simple as that. Hello? Reda's rushing on to the next 12 examples, but anyway. No, you're all happy. So, all the beta ever means, it's such a simple concept. If the beta's 0.8, it means it's 80% as risky as the market. If the beta was 2, it means it's 2 times as risky as the market, and so on. You clear? And so this bit you have had before, but even so, would you all agree? If you end up with a beta of more than 1, what does that mean, please? Well, let me say, surely. If it's more than 1, if the beta's 2, 3, 4, it means it's twice as risky. 3, it's more risky than the market. Reda said average quite correctly. The market is the average return. If the beta is less than 1, it's less risky than the market. And I hope, clear enough, but could be important later, what would it mean if an investment had a beta of 1? Yeah, it'd be 1 times as risky. It would be the same risk as the market. And what would it mean if the beta was 0? Oh. 2 means it's 2 times as risky. 0.8 means it's 0.8 times as risky. 1 means it's 1 times as risky. What do you think 0 means if an investment had a beta of 0?
No risk at all.
Yeah, surely 0 times as risky, there would be 0 risk. Would you agree? If an investment had a beta of 0, we say there is 0 risk. Or, the better term, we call it risk-free. Now come on, 2 of you screwed your face up. Would you agree with me? Now in real life there's no such thing as an investment with 0 risk. Any investment has some risk, obviously some more, some less. The closest thing to it, and for the exam, if it's ever mentioned, the one we assume is 0 risk, is government securities. Government securities? When you lend money to the government? Hello? You're all clear what we're talking about? Mm-hmm. Now, of course, you might think that I said nothing's risk-free. You might think that might be quite risky these days, lending money to the government. But you can see why, in principle, certainly short-term, that's regarded as being a risk-free investment. Okay? So again, nothing's perfectly risk-free. But later we need risk-free crops up. If ever you see government securities mention this type of question, you would assume they were risk-free. Okay? 2 very quick little things here. One is, I haven't written, but I hope you're already clear that when I say more risky, less risky and so on, we are talking purely about the systematic risk. Look at the formula. Because provided we're well diversified, I don't care what the unsystematic risk is, it's irrelevant, it disappears. Alright? So all the time you're saying, oh, the systematic risk is more than the market, less than the market and so on. Secondly, in theory, beta can be negative. In the real world, it virtually never happens. In the real world, all shares tend to go up and down together. You know, some more, some less, but there's positive correlation. Are you with me? The only example, but I wouldn't bother writing this, but the only example of something that in fact tends to go the other way, and the beta will be minus, negative, are in fact shares in gold mines, gold shares. Because it tends to be the case that, you know, if economies do badly, share prices go down, people put the money in gold, so they go up, and vice versa. So it can, theoretically, can have negative betas, but normally, no. I say gold is really the only sort of practical example. Okay? All right, just one more thing before break. But anyway, you see what I mean? Individually, trivial little formulae, you know? It's annoying to have a whole series that you just could throw in. But just a puzzle which Red has obviously already done, but still. Look at example 3. Which I'm quite proud of, in that for about 10 words there, it's testing you on 3 different formulae. The total risk is 15. The unsystematic is 4. The variance of the market is 30. I want to know the beta. All right? All right, I won't delay your lunch. Let's do it together. But it's typical of what the old examiner used to do. There's 3 easy formulae here, all at once. Hello, let's do it together, please. I'll let you do some this afternoon. The beta is the systematic risk over the risk of the market. True? Let's start with the bottom. I want the risk of the market. How can I work out the risk of the market? Well, one formula I wrote up earlier and I said could be needed. I said standard deviation is the square root of the variance. Do you remember? And so I'd already written that earlier and said you might need it. It's the square root of the variance of the market. The variance is 30. So the standard deviation of the market is 5.48. Am I right, Reda? Thank you. Sorry, something went funny. 5.48. And as I said, you'll never be working out from first principles. You're going to need standard deviation, almost certainly. He'll either give it you direct, or he'll give you variance. Okay? That gives us that. But of course we also need the systematic risk of the investment. I've told you the total risk. Well, that first formula in this chapter, the total risk squared, is the systematic risk squared plus the unsystematic. And so it's like that first example we did. Here the total is 15. It's the systematic squared plus the unsystematic is 4. And so the systematic, the square root of 225 minus 16. Reda, is it 14.46? Natalia? Ekaterina? And finally, what's the beta? Well, we now got what we need. The systematic is 14.46. The market is 5.48. And so the beta (2.64). And again, the interpretation. This investment is 2.6 times as risky as the market. Okay? And so, of course, since it's very risky, you'll want a high return. The higher the beta, the more return you'll need. The lower the beta, the less return you'd accept. Okay?
But this beta is for this specific industry or for all industries taken together and then calculating?
No. Be clear. We're saying the systematic risk. Sorry, everybody's writing here. If you've got a beta of 2, then I'll keep saying 2.64. This particular share, the systematic risk is twice as risky as the market. Okay? That's not what you're asking me, but you all agree. Well, remember, systematic risk is the risk due to economic factors, inflation, etc. We're saying all shares in this particular industry will have the same systematic risk. All right? So if this happens to be an oil company, all oil companies would have a beta of 2. Each individual oil company might be more risky, less risky, but that's because of the unsystematic factors. But there we're not interested in. So, oil companies may have a beta of 2, all of them. Obviously in the real world it's not perfect, but they'll all be very close to 2. It may be that telephone companies perhaps aren't as risky. Maybe they have a beta of, let's say, 0.8, but all telephone companies in an ideal world would have the same beta.
You can compare different.
Oh, you can compare different sectors. Yeah. But the betas apply to the sector.
Yeah.
And in theory, every company in that sector would have the same beta. And it's that determines the return. So, okay?